Good morning and welcome to the webinar. This is Roger Royse, the founder of the Royse Law Firm, which is a business, corporate, and tax law firm with offices in Northern and Southern California. Today's webinar is on FATCA, an overview. Where are we now and where do we go from here? We have with us a panel of experts on this new law. Today we're going to have a little bit more of an informal discussion format. We'll go through the highlights of the law, what it is, how we got here, what it's designed to address, and what we think is going to happen in the future. And as we go through, I want you to notice on your screen there's a chat box. And if you have questions, please type them into the chat box, and our panel will try to address these questions over the next hour. And to the extent that we cannot, we'll have a copy of those questions and we'll be able to follow up with you directly. So this is part of the Royse Law webinar series where we, on about a bi-weekly basis, address topics of tax, legal, and technology issues. Today's webinar, of course, is on a technical tax issue that we hope to be able to explain and make understandable. Our upcoming webinars this year that we have planned will be on the topics of food tech, transportation tech, and possibly health tech, although maybe not by the end of this year. So stay tuned and sign up for our list. We typically post these webinars on our Royse Law YouTube channel. You'll also find the slides on royseuniversity.com, as well as in the iTunes store, downloadable as a podcast. So with me today, we have Richard Hinton, who is a second partner at KPMG, a Big Four accounting firm. He's in the San Francisco alternative investment practice. He has a particular focus on the hedge fund industry, has 17 years of experience with KPMG, and has held a number of positions within their audit and advisory functions, both in the United Kingdom and globally. We also have Mary Kopczynski, if I'm pronouncing that correctly, the CEO of the management consulting firm 8 of 9 Consulting, Inc. She's recognized as one of the country's leading financial regulatory consultants, having advised some of the world's largest global investment banks in this area. Although Mary is on the East Coast right now, she spent 4 years here at Santa Clara University, where she has a Ph.D. in global affairs and a J.D. from Rutgers University. We also have John Golub in our office to address how FATCA interacts with the new FBAR requirements. John is a tax lawyer here at Royse Law Firm in Palo Alto, and I will be your moderator and host. I'm Roger Royse, the founder of the Royse Law Firm. So I thought what we would do is start with somewhat of an overview of what the law is and how we got here. So just for, by way of background, FATCA was passed, the Foreign Account Tax Compliance Act was passed in 2010 as part of the Hiring Incentives to Restore Employment Act, the HIRE Act. The IRS issued proposed regulations in February 2012 with final regulations in January 2013, and as part of this implementation process, the United States has been signing what they call intergovernmental agreements with countries around the world. We'll talk more about that during the webinar. The start date for FATCA compliance has been set and moved a couple times, and now the start date is generally July 1, 2014, but there's a little bit of confusion around the start date and effective dates, and hopefully we can explain that today as well. So the general idea behind FATCA, of course, is that the IRS believes that there are a lot of people who have accounts in foreign institutions that are not subject, that they are using to hide income and underreport income. And FATCA is a mechanism that basically requires these foreign financial institutions, such as banks, to either get into the system and report and disclose information regarding U.S. account holders to the IRS so that they can be audited and subject to tax and reporting, or if they don't, that those foreign institutions are subject to withholding tax on any payments of interest, dividends, or other types of fixed or determinable annual or periodical income to the foreign institution at a 30% rate. So that's the general idea. The foreign bank either has to report to the IRS, or if it doesn't, the IRS assumes the worst and it withholds on all sorts of U.S. Certain sorts of U.S. source income to the foreign institution. That's the background. And at this point, before we dive into some of the rules and how they work, I guess I would ask you, Richard, if you could maybe give us a summary of how we got here and what the policy is behind this new law and what maybe some of the issues are that's driving this initiative.
Thanks, Roger. I mean, it's been, when I was driving down here before speaking today, I realized it's been more than 3 years now that I've been talking about FATCA. And when I go back to those first seminars in the summer of 2010, after the Hire Act had been passed, the level of fear in the financial industry, the financial community was very significant. And that's because this law is extremely pervasive. The policymakers, in drafting what is essentially a law that's meant to eradicate tax evasion from U.S. citizens, U.S. persons, have learned a couple of very useful lessons around how the financial industry had been facilitating tax evasion. The first was the famous Swiss bank case. And the genesis of that really was the previous withholding tax regime, the so-called Chapter 3 rules, the QI rules. That was set up to operationalize taxes, to make things easy for people, make things easy for financial institutions in order to operationalize withholding and make things simple. But about 10, 12 years ago, the IRS started to use the QI process to collect data on US persons. And for many US persons that had accounts in overseas banks, that was very unwelcome sort of transparency on their financial affairs. And so in order to protect that customer base, a lot of these financial institutions started to facilitate, by hiding them behind trusts and other blocker entities, facilitate their sort of protection from that QI regime and the transparency it was triggering. I think at some point, though, rather than helping those clients to minimize their transparency, it suddenly became a customer sort of a way of actually attracting customers. And some of those institutions then crossed the line, I think, in terms of the authorities' eyes, and used this ability to protect you from the QI regime, the transparency of the QI regime, as actually as a way of attracting and gaining new customers. And so one of the Swiss banking officials who was arrested in Florida had been essentially selling those products to wealthy Americans onshore as a way of hiding their income. When they arrested that guy and they ripped apart that financial institution, they learned an awful lot about how financial institutions have been using trust structures, been using the international payments network to facilitate tax evasion. And those learnings are captured in the law, and that anti-avoidance is buried deep within the legislation, and that's what causes the operational headaches, because they've included a number of aspects which are impossible to operationalize, but you can see the genesis of it back in the lessons they learned from the financial engineering that was going on to help high net worth individuals in the past. In parallel to that, the authorities were also getting extremely upset around the use of synthetic income to bypass certain tax rules. The classic example that's often quoted is the Microsoft dividend. So when the Microsoft paid a big one-off dividend in the 90s, it was an event that a lot of hedge funds and offshore investors were able to plan around, and they were successfully able to avoid any withholding tax consequences by the use of synthetic instruments. And the authorities really resented that. It was legal, but they resented it. And again, in terms of some of the real headaches in FATCA, you're seeing the lessons learned from that episode translated into a much broader definition of what US income is now, a use of synthetic, the use of synthetic income and so on and so forth. So bringing back to your point, Roger, so the policy is to drive out tax evasion, and the goal is to do so is to force foreign financial institutions to provide additional transparency. but in the detail is an awful lot of hard lessons from these sort of test cases of the past. And that's where I think we've had, over the last 3 years, the most difficulty with financial institutions trying to implement it.
Okay, thanks very much, Richard. Slide. So, as mentioned, FATCA was passed back in 2010. We got proposed regulations in February 2012. We got final regulations of January 2013, which were generally effective then, with a start date of January 1, 2014. And the start date has now been pushed back to July 1, 2014. So the first question before we get into the meat of the law that I would pose to our speakers is, well, first of all, why the delay? Why has this been pushed back yet again another 6 months? And does that mean we don't have to worry about this for another 6 months? And Mary, maybe you have an opinion here or some insights as to why this continues to be delayed.
I sure do. So to give a little bit of background, 8 of 9 does regulatory change management. So yes, you did mention those credentials that I have, but the asset I think that is the most helpful is that I'm a translator. So I can take the technical requirements and basically help people understand what they really have to do. The truth of the matter with implementing FATCA on a large scale is, well, first of all, when you're a huge institution, you need to build technology processes that actually can help you facilitate the withholding if necessary, if you're a foreign financial institution. So that means you have to look at your clients and break out whether or not this income is U.S. source or not, whether or not they're a member of certain IGAs, if they're going to report on their own, or if you're reporting to the government on their behalf. And so it's kind of like a really painful decision tree that you need to build. And obviously, if you're building technology for a huge decision tree, you're going to want to know what that tree looks like. Because there are only, I think it's however many IGAs have been signed, I think it's like 9 that are official and done and dusted. There's 33 that are, in pencil. They're not 100% complete, but there's still a lot more countries in the world that are in negotiations or haven't even started. And so when you're trying to build this complex decision tree, you'd like to have all the variables. And I think that the Treasury realized at a certain point that it was just going to be a very, very complicated implementation, and that is why they gave the delay. The first one, then the second one. So I think that's in essence, yeah.
I have a slightly different position. I think the delay essentially is recognition that the IRS has won this battle comprehensively. Within the laws, as I touched on, there were a number of aspects that were impossible to operationalize. There's the concept called pass-through payments. And a lot of that comes from this, the need for the law to sort of look through blocker entities that individuals have been traditionally using to hide behind. And so by creating a requirement to pass, for income that passes through entities to also be withheld upon, they created a mechanism for sort of essentially policing and holding to account for all financial institutions in sort of the payments stream. It was impossible to operationalize, but it was also impossible to, it was, as we used to say, you were facing a situation 3 years ago where you were probably going to go out of business or go to jail or both. And there were plenty of institutions whose business models were fundamentally threatened by this. But it brought everyone to the table. It brought everyone, and it also brought foreign governments to the table. So the intergovernmental agreements that we're seeing across the world are a result of what was almost a diabolical set of rules. But in a way, the IRS has recognized that they don't need to implement them. Just like having a nuclear weapon, the threat of it has been sufficient to bring everyone to the negotiation table. In my view, the delays are almost a tactical as well as a practical sort of reality from the IRS and Treasury, allowing that sort of new consensus to emerge, allowing this network of IGAs to be put in place, so that the nuclear option buried in this law never has to come to pass. And in that sense, you can look across the world, and governments have achieved a long desired policy outcome of total tax transparency. Reciprocal arrangements between multiple states are appearing almost on a monthly basis. So it's not just an American factor anymore. The British are having the same rules with other European countries, and so on and so forth. The Chinese are considering the same kind of rules for their own purposes. So for me, the delays are almost evidence of the success.
Well, with that, why don't we just drill down a little bit into what the FATCA rules are. Next slide, please. So just by way of background, so that we're all on the same page, what FATCA does, first of all, it applies to foreign financial institutions. Those are non-United States entities engaged in banking businesses primarily that hold financial assets for others as a part of their business, or, this is important, they're in the business of investing or trading securities or partnership interests. So this will cover, here in the Silicon Valley, this will cover a lot of the investment funds that we often see doing business here in the Valley, investing in portfolio companies. Now, if a company is a foreign financial institution, it has three options. There's three things that could happen. Number one, it could enter into an agreement with the Internal Revenue Service and become what they call a participating foreign financial institution. And we'll talk about other types of foreign financial institutions, but if they're a participating FFI, then the IRS assigns it a global intermediary identification number. Okay, so it gets a number, it's in the IRS system, and it has to maintain a compliance program that will provide the IRS with required information on its U.S. account holders. That's number one, and if it does that, it avoids this nuclear option that Richard mentioned, the 30% withholding on its U.S. source income. Alternatively, it can do nothing, and it's just going to pay the 30% withholding or be subject to it on dividends and interest from the U.S. and later on down the road, the proceeds from the sale of U.S. securities. And if you're a foreign investment fund doing business here, you can imagine just what a disaster that would be to be subject to 30% withholding on all of the proceeds from the sale of a U.S. security. And although there are treaty rates that may reduce the amount of tax they have to pay, it's not going to affect the withholding requirement at all. Similarly with interest, we're all probably familiar with the fact that there's this portfolio interest exception so that payors of U.S. interest rarely have to withhold. Well, that doesn't apply for purposes of FATCA. That withholding is still going to be applicable. And thirdly, and this is maybe the most interesting part about this, is that the FFI can comply with the terms of an intergovernmental agreement if it's available, if the U.S. has entered into an agreement with a foreign country in which they may not have to report to the IRS at all. They might be deemed to comply by reporting to their own country. So that's the summary. And with that, why don't we just go ahead, one more slide before we dig down into the meat of this. The compliance requirements, in particular, the information that has to be reported will include the name, address, and taxpayer identification number of the U.S. account holders, the account number and balance, and any payments of interest during the year. And the U.S. taxpayers, there's an ancillary requirement here in that the U.S. taxpayers that have these foreign accounts, they have to complete a form and list their foreign accounts, and then that gets compared to the information that's received. Now, there is a website, there's a registration portal, it's web-based, so you can go onto this website if you're a foreign financial institution and you can register, you can get this number, and it's at irs.gov/FATCA. So, you know, the IRS is using technology to enforce this requirement. Next slide, please. So that's the basic thing. The thing that you probably have been hearing most about recently has to do with the intergovernmental agreements. And let me just summarize these, and I'll ask our panel to weigh in as to how important this intergovernmental agreement, this IGA process is. So there's really two different kinds. One, the Model 1 agreement, is agreement where the countries will agree to share information. So 1A is where there's a mutual exchange of information process. So for example, we have such an agreement with the UK, US-UK. So UK financial institutions report information about its US account holders to the UK government, which will then share that with the US. And the US banks do the same for UK residents. And then it's passed directly between the US and UK. Model 1B is a non-reciprocal agreement where the other country collects the information on US accounts and sends it to the US, but it doesn't go the other way. And I'm not aware we have any agreements like that as of yet. Oh, do we? Richard
not yet enacted, no. I think there's, yeah.
Not yet, but there's some maybe in process. The Model 2 agreement just permits the FFIs, the foreign financial institutions, to send information directly to the IRS under the FATCA rules. But the agreement is that in the past, there's been restrictions because of foreign bank secrecy laws that would prohibit them from doing that. These inter-country agreements now will prevent the foreign bank from violating domestic bank secrecy laws if it complies with this agreement. And the beauty
Japan
of this,
I was just going to say, Japan just signaled that they're probably going to do an IGA too, if anybody's wondering.
Okay. So Mary, can you tell us how many of these such agreements are in place right now? Do you know? Do you know what the latest count is?
There are 9. Model 1s are Denmark, France, Germany, Ireland, Norway, Spain, United Kingdom, and Mexico. Those are all officially done and dusted and signed. And then Switzerland is our sole signed Model 2. And then essentially Japan just signaled that they're probably going to do a Model 2. And there's a whole series that they were saying that there's 33 that are, penciled, that they're nearing their final particular agreement terms, but they still need to ensure that their internal regulatory systems will pass legislation to make it go through all the way.
So let me take a step back and ask what may be an obvious question, but maybe not. And it's, why would a country do this? Why would a foreign country enter into an agreement where it's going to force its residents, its local banks, to violate, even sometimes violate its own bank secrecy laws absent the agreement, and provide this kind of information to the Internal Revenue Service? What's in it for them?
Well, I mean, there's a lot in it for them. I mean, this goes back to my point in that I remember when we began lobbying against this regime. I was in London at the time. We began lobbying against it, and we were always a little bit disappointed at how lukewarm the UK government was to sort of going to battle on behalf of the financial industry. And now we see the IGAs emerging, and who can blame them? Because they saw an opportunity to affect their own policy objectives, which was tax transparency for their own citizens. Because the IGAs do a number of things. The concession that the US has provided into the IGA signatories is very significant. It takes off the table withholding in any meaningful sense of the word. So the usual option of withholding, particularly on pass-through payments, essentially dissolves away. The second thing it takes off the table is the concept of responsible officer. So there was this, which perhaps we'll touch on later, but there's this requirement for an individual under the full FATCA regime to sign on the dotted line, sign in blood of the pain of perjury for various certifications. Well, in an IGA agreement, that responsible officer role is no longer there. These are two very big concessions, and they allow you, it allows you to operationalize the rules much more easily. But what did they get in return? Well, the government's also got, apart from those concessions, they got the promise of reciprocity from the states. Now, we don't quite know how that will be effective in practice, but what we have seen is that everything the American government has done indicates they intend to honour that reciprocal arrangement. And so countries like the British and the Germans and are now going to be able to get tax transparent data on their own citizens residing and earning money in the United States. And I think that's an extremely important concession, and was probably one of the big reasons that governments have flocked to sign up.
Yeah, let's think about that for a minute, because I think that's really big. So, you know, the Mexican government is going to, for example, disclose information about its Mexican financial institutions, and it's doing that because it wants to know about Mexican nationals who have accounts here in the U.S. that they're not paying tax on. So, in a way, this is much bigger than just a U.S. tax compliance issue, isn't it? This really is a whole new worldwide tax information sharing agreement. And, you know, the first question I had when I looked at this, I said, well, geez, the United States, it has information sharing agreements all over the world. Why isn't that sufficient? And I think the answer is probably that you have to know who your taxpayer is, for example, a place like Switzerland, that you're requesting the information on before you can even get it, if you can at all, because of secrecy laws. And this goes way beyond that, doesn't it? Because it forces the foreign banks to just come forward and disclose these accounts to the IRS that might not even be on their radar. Mary, did you have anything to add to that?
Well, you know, we were just having a discussion today about along the same lines of what would persuade a company or a country to choose Model 1 over Model 2. Because if you think about it, Switzerland in essence is saying like, all right, fine, they can go ahead and report to the IRS, but we're not going to have anything to do with it. Whereas Caymans, for example, they're thinking is going to do an IGA-1, and the thought is that, you know, Cayman still wants to be a great jurisdiction to do business, and if you're doing business in the Cayman Islands, then presumably you're just reporting your data to the governments and authority of Cayman Islands, and that's all you have to worry about, because they will have the responsibility of reporting to the United States. Whereas if you're doing business in Switzerland, you're on your own. You know, you have to take care of that relationship with the IRS. So there's pros and cons either way, and I think also the countries are sort of figuring out what's going to still keep business in their walls that makes it still a good location to come and get your business
I mean, I agree with you, Mary. I think it's not an accident, though, that most of the IGAs in discussion are Type 1s, Model 1s.
Right.
Model 2 really is, you know, has only been looked at by those institutions that are very concerned about, you know, contradictions with existing law. So I think that in this case, actually enacting a Model 1 agreement would have been, from a legislation perspective, very difficult. So
yeah, that's what with Japan, I kind of think the view is like Japan is known, they're kind of like the United States, that, you know, look how great our Congress is doing on passing laws these days. Japan has a similar sort of cumbersome system for passing laws, and I was opining, I could be wrong, but one of the reasons Japan has picked an IGA-2 is just because they know it would be too hard to build, you know, internal agreement toward a process for reporting directly to the Japanese authorities. It might just be easier if they tell everyone they're on their own.
But Roger, I mean, to sort of wrap up the IGA story, so in one sense, you're no longer going to jail because responsible officers and the sort of penalties of perjury requirements around responsible officers is taken off the table, and you're probably no longer going out of business because this sort of apocalyptic withholding is being taken off the table. But you face operationally a much bigger challenge, because now we have 30 or 40 versions of the truth. You really are going to face country by country specific rules. So as an example, in the United Kingdom, the way that they've operationalized the IGA, you know, creates differences to FATCA. In some respects, it's harder than to influence in FATCA at an operational level. There's a requirement, for example, for individuals who deal with UK financial institutions to self-certify that they are not US citizens. Well, that certification process doesn't exist in FATCA in quite the same way. And so it's become like, it's kind of, I've noticed that the C-suite kind of gone to sleep on this. And the poor people who've now been told to implement it have an even greater headache, and no bigger budgets, frankly, to get this done. And there's going to be a number of, I think there's going to be quite a lot of pressure points over the next 6 to 8 months, because going back to the timeline point, while we've had plenty of delays, this thing finally goes live in a real sense next July, when the first withholding will get triggered, and when the requirement to begin onboarding in a compliant fashion is triggered. And those aspects, the reporting and the onboarding requirements, the due diligence requirements, don't materially change just because you're in an IGA world. So that due diligence, the hard work that financial institutions have to do over its customer base is still there. We've just taken off the table some of the really impossible to operationalize aspects.
Right. So let's pause on the operational aspect of this. We've been talking about the foreign financial institutions, but there's this concept of a U.S. withholding agent in this. And for the benefit of our audience, a lot of whom will find themselves on that side of this, I guess let's talk a little bit about what that means for them. So in other words, if we have somebody who is making a payment to a foreign bank or a foreign financial institution of interest, dividends, or even the proceeds of the sale of a security, what is that payor going to have to do at this point? So Mary, do you want to summarize a little bit of the operational issue?
Well, essentially, the big date that everybody needs to know about is the 1st of July. And that is essentially the date that a withholding agent, your new accounts, your brand new accounts, not your old ones that have already existed, but your new accounts need to be in compliance, and you need to be able to begin income withholding or reporting, but you need to be reporting the interests, or whatever you just showed earlier. You have to actually have the infrastructure so that it can be reported through whichever structure around the world is involved. That's the big deal. But there's a later date where you have to have all your old stuff in compliance. And you know, the interesting thing about it is that the harder thing is your legacy agreements getting in place, because in this sort of regulatory environment, the movement is actually toward consolidation. So instead of having, you know, hundreds of thousands of different funds, like lots of big banks are actually contracting, so that they're merging or dissolving entities that are, you know, sort of, they were a good idea at the time, but now there's just so much regulatory requirements associated with them that it's just easier if there's less of them. And so the day when the legacy agreement relationships go live is, I think, where most of the work needs to be done. From my perspective in the investment banks, because of all of the financial crisis over the last 5 years, there have been mergers and acquisitions, and every time you do that, you get legal agreements and records and diligence and just like volumes of data that come in different computer systems and don't match up. And so much of the implementation difficulty from this perspective and FATCA is just having an idea of what legal entities you even have under your belt. So even understanding where they're located, what should be classified, whether or not their country is the correct country for purposes of tax. There's a lot of cumbersome work involved in being a withholding agent when it comes to the legacy agreements. But the big date, July 1st of 2014, that's the date that just anything brand new, you have to be ready. So everybody is racing to make sure that their systems are alive and go for the new guys, so that when that other date comes out, there's a nice, simple process for people to follow.
Yeah, and of course, as under prior law, the U.S. payors are entitled to rely on exemption certificates, W-8 or W-9. I understand there's going to be some new forms if they're not already out.
That's right.
drafts are out, draft forms are out under FATCA. In other words, they'll either have to get a withholding certificate or certify compliance by one of the alternative methods, or maybe even under an IGA, as you say, or they have to withhold 30% reported on Form 1042. You said something really interesting there that I want to pause on. Even though we've got a July 1 date for new accounts, and the old accounts, of course, are being grandfathered in for a little while anyway, is there anything that, well, both the financial institutions and maybe even some of the withholding agents should be doing right now to prepare for this, even though we've got 6 months to go?
Well, I think what we're finding, because the US withholding agents issues are actually, in my experience, the ones that are causing the greatest grief at the moment. I think it perhaps got under the radar when everyone was thinking about foreign financial institutions the whole time, and for the onshore community making payments overseas, their obligations have changed significantly as well. And also one of the practical outcomes of that is that a lot of FATCA projects are turning into Chapter 3 projects, i.e., if FATCA was Chapter 4, there was already an existing Chapter 3 withholding tax law, so-called QI regime, and non-compliance or sort of poor quality documentation around their existing obligations has come to light as they've started doing the due diligence on FATCA. And actually, we're seeing a lot of people getting their house in order on their existing obligations first, even before FATCA comes into place. So it's not uncommon for companies to be requested to repaper their W-8s and equivalent documentation at the moment, as the financial services industry gets its house in order. I think you're right. The hard deadline is July. What can you be doing now? I think you have to, bear in mind that while there are some helpful timelines and some helpful delays to some of the harder aspects of the due diligence work, at the end of the day, you know your commercial exposure. You know the kind of payments you're making. You know the counterparties you're making those payments to. And for me, sometimes you lose sight of actually managing that traditional commercial risk and reputational risk that comes from dealing with customers and individuals who might be impacted by this. So my advice is always to try and put that customer focus onto your thinking, because you want to start the communication process as soon as possible so that there are no last-minute rushes and surprises for important relationships in your client and customer base.
Right. We'll go to the next slide, Yvonne. So we've talked about FATCA from the perspective of the foreign financial institutions. We talked about it from the perspective of the withholding agent. We even talked about the political issues, the perspective of the governments. I think I'd like to pause a little bit on the perspective of the account holder, the U.S. individuals that have these foreign accounts, and some of the reporting requirements that they're going to have, and also how this interacts with the FBAR rules, which I know a lot of you are familiar with. So John Gullivan in our office has done quite a bit of work in this area. And John, could you give us a summary of what the reporting rules are for a U.S. person who has a foreign account?
Sure, Roger. So as you mentioned, the HIRE Act imposed a new reporting obligation for U.S. taxpayers on Form 8938. And that is similar to what is already an existing obligation under the Bank Secrecy Act to report on the Form FBAR, which is also the FBAR is the common term for the form, but the detailed and the actual form is TDF 90-22.1. So there's two forms that cover this reporting obligation of U.S. persons, but they differ in a variety of ways. Starting with the HIRE Act form, the Form 8938, the form is actually much broader in that the reporting of a U.S. person applies to foreign financial assets. And it's not just bank accounts held at foreign financial institutions. It's reporting of foreign stock holdings, interest in foreign entities, interest in foreign trusts, pensions, foreign deferred compensation, foreign debt, like a note or bond, foreign other options, or foreign financial instruments. So all of those things, if they are in value above a certain threshold, which is $50,000 generally for U.S. persons living in the United States, that threshold changes whether the person's living in the U.S. or in a foreign country, and whether they're married or not, and different things. But if the value of those foreign assets is above that threshold, then the person has to report them on this Form 8938, which is then filed with their U.S. tax return on an annual basis. The existing form that I mentioned under the Bank Secrecy Act is the FBAR, and that really only applies to foreign financial accounts. So bank accounts, other investment accounts, and not this sort of wider array of financial assets. And the thresholds are different. For that report, which is required on an annual basis as well, the report is filed when the aggregate balance of all of those accounts that an individual might report is in excess of $10,000 in the particular year. So it's a pretty low threshold, and it's pretty regular for anyone who has lived in a foreign country or worked in a foreign country to have this obligation, because they might have a bank account still existing in that country. And another way that these two forms differ is in the penalties that could apply for missing them. So you have the Form 8938, which is the newer form. The penalties are somewhat more what you would expect if the IRS realizes that you didn't file your 8938 when you should have, and then you're notified about it. You potentially owe a $10,000 tax penalty to the IRS. That penalty also increases for every month that you don't pay it, up to a maximum of $50,000. Under the FBAR rules, the existing Bank Secrecy Act, the penalties are somewhat harsher, and I think it's mainly because that act was originally passed to sort of deal with money laundering issues, and not so much just the normal run-of-the-day American with a foreign bank account. But failing to file that form, the penalty depends on whether or not the IRS believes you were willful or non-willful in failing to file the report. If you were non-willful, then the penalty is $10,000 or up to $10,000 per violation, which can add up kind of quickly if you have a number of foreign bank accounts and you've maybe violated this report for a number of years. If you were willful in your non-filing, meaning that you had knowledge of the report and you failed to actually provide it to the IRS, then the penalty can be the greater of $100,000 or 50% of the foreign bank account balance. And in some cases that can be a gigantic penalty, assuming someone has a lot of money in a foreign bank account and failed to file this form willfully. So a lot of taxpayers in the U.S. are dealing with this. I think the HIRE Act and the new form sort of was a response to what Richard mentioned earlier, which was the information that the IRS found out about how certain foreign banks were conducting business in the United States. They began to focus very heavily on the existing reports that were required under the FBAR rules, and then also passed this new rule to require reporting on the Form 8938. So they're similar, but they are somewhat duplicative, and there's two reports that people need to worry about sort of on an annual basis with respect to foreign financial assets.
Okay, thank you, John. So let's turn to some of the questions from the audience. Again, being where we are, of course, the big question is how is this going to apply to investment funds? And really we have to think of this two ways. Number one, we now have here in the Valley foreign investment funds doing business here. And under this definition, a foreign, for example, your favorite Cayman Island venture capital fund or Luxembourg fund making an investment into a U.S. portfolio company is going to be subject to these rules. That is going to be a foreign financial institution. And by default, they're going to be subject to 30% withholding on interest, dividends, and then later on down the road, proceeds from the sale of those investments, unless they get into the system and become a participating foreign financial institution. So anything to add to that from our speaker?
Yeah, no, I mean, in terms of the industry issues here, there are four things you need to consider. think as the investor's perspective, there's consequence for portfolio companies in those investment portfolios, the various counterparties that you're interacting with, and finally, there's also some issues around the lenders that provide leverage into the structures. It's a bit difficult in this context, in this sort of forum, to walk through a case study of how a full investment fund gets impacted. But at a high level, the foreign financial institutions that are involved are likely to be either onshore, and therefore essentially not foreign by definition, or offshore in a recognized jurisdiction. And most of the industry now has a very high level of confidence that those will be in IGA countries by the time it matters, which is next July. So we have 8 or 9 today. We have 30 or so in the pipeline. Cayman is the biggest one, but BVI and others are all in that pipeline, and we know they are very close to finalising their agreements with the IRS. So from the fund structuring perspective, you should be in a reasonably, not straightforward, but in a place where you can navigate that and the rules will become clear. Some of the challenges then become in identifying the common control of those groups, who are the beneficial owners of the various limited partnerships and feeder funds that you've got in that group. It might potentially be a common control group, and in fact, in terminology, they have this concept of an expanded affiliate group, which potentially has its own sort of compliance consequence. But then the question then moves down to the portfolio company level. Now, the portfolio companies are unlikely to be foreign financial institutions, so you do need to be careful. There is a definition. If they are in the financial industry, they could trigger the definition. But on the whole, you would probably expect them to be what the other term, which is the NFFE, the non-foreign financial entity. So NFFEs can also be withheld upon if they are not actively trading and also subject to certain exempt categories. So a passive NFFE, a holding company that isn't the financial institution, but is a passive company that whose income is more than 50% of the income is generated passively, they are in scope. And so when you look through the investment holding structure, you need to begin to understand those subtle rules for NFFEs to identify where your risk points are within the new reporting regime. And that's just a little bit of hard work. That's just some homework. We don't find, when people do that homework, that there are some great calamitous outcomes, but you have to do it. And so to one of your earlier questions about what you should be doing next, it's the process of mapping that and analysing and categorising all those entities in the wider investment group and the portfolio company level that's important. So you have a proper picture of how you're going to have to interact with the law.
And it seems like it would be wise to start doing that now, even though you anticipate that we will have IGAs in place by July.
So exactly. So it's been de-risked substantially, but now operationally, there's just a lot of paperwork. There will be a lot of forms that are going to be new to you, a lot of forms that are going to be new to your investors and to other counterparties. And so the sooner you've catalogued your, essentially at an entity level and at a payments level, what you're doing, the sooner you'll be able to get your head around how big an issue this is for you.
Yeah, and that leads us into this whole issue about what to do with foreign pass-through entities, which I found to be quite painful reading to try to figure out all the different ways that you could deal with it. But I think what I'm hearing here is that it may not be an issue at all because of the IGA process.
That's my personal view. There are still going to be jurisdictions out there that don't enter IGA territory. Pakistan, possibly some South American countries. So it's not to say it's going to be an issue. Most large firms, and perhaps I don't know if Mary has some perspective on this, but most large firms that I work with, most large banks, diversified groups globally, have a zero tolerance policy. So they would rather not do business with you than have the risk that they have to implement this kind of withholding engine, because the cost of implementation is just unacceptable.
Yeah, for the audience, what we're referring to is that under the rules, a foreign pass-through entity, unless it gets into the system and complies, actually will, there's 3 ways it could go. If it's a non-U.S. fund, it's either subject to withholding, if it's non-participating, whether it's a flow-through or not. But suppose it's a flow-through entity, it's a partnership, but it's what they call a participating foreign financial institution, then it's not subject to withholding. Where we've got a problem is if we've got a non-U.S. fund that's deemed compliant, it could be subject to FATCA withholding if it has investors itself who are not compliant, to the extent of the payments attributable to those investors. So that means that the foreign fund has to, allocate the income it receives to those non-compliant investors, and withholding is imposed on that basis. And then if the U.S. withholding agent doesn't withhold, then the fund itself may have to withhold. So you can see that that could be a real compliance headache. Mary, do you have a perspective on that?
Oh my goodness, that's you guys are so deep in the weeds. I mean, it's the first is figuring out what you are. I mean, to give practical advice to the audience out there is you do need to figure out what you are, and there's probably like 40 or 50 different categories where you can fall into. So registered, deemed compliant, PFFI, like there's all these different codes and acronyms that there's lots of different software and compliance tools coming out on the market to try to just what you are. And then once you've figured out what you are, you have to figure out what you need to do next. And we could get into like really convoluted, because a lot of what I focus on are things like securitization structures, with waterfalls and linked hedges, like, where it gets into like the crazy dark arts of derivatives, and coming to those definitions is not clear. And there's a lot of letters out right now in regards to special purpose vehicles, for example, from both SIFMA and ISDA saying, come on, let's give a little bit of relief here on some of these entities. But once you've figured out what you are, then you need to figure out what exactly you need to do. And that's to register or not to register. And then once you actually have and when it comes to registration, we sort of touched on it earlier, but there is this concept of an expanded affiliate group, which is if you are a large-scale entity that has a lot of ownership of companies underneath you that are owning other companies underneath you, if you have your own organization chart of entities that you own, you can register on behalf of all of them. And there is this concept that if you fail to register on behalf of all of them, and it turns out one of them should have been under your control, you have put your entire expanded affiliate group in violation of FATCA. And so we lovingly refer to it as you blow up your EAG. If you get one wrong, you get the whole thing wrong. So you don't want to blow up your EAGs. You really need to make sure that you know who you are. The other difficulty of this process is that when it comes to knowing who you are and what you're in control of, keep in mind that that can change, right? So people are constantly selling shares of stock from one entity to different shareholders, so it's a constant fluctuation of ownership. And you need to have a process in place that's going to help you alert if something is going to change. Like, you need to have controls so that for sure whoever it is that is registering these entities and keeping them in compliance, so to speak, are at least alerted if enough shares are sold or purchased to shift over whether or not you're a majority shareholder. But then once you figure out, okay, this is my, let's say I had 100 entities underneath me, and of these 100 entities, let's say, 40 of them need to register with for withholding or reporting and all this good stuff. You also need to know what every single one of those clients are. And so that is its own large exercise to figure out who are you doing business, and of those people you're doing business with, who are they? Are they a registered deemed compliant FFI? Are they a, Model 1 reporting partner? Like, you have to know what they are to determine how to build your withholding system. So for any of you on the line that have not gotten started, it's definitely time immediately. Like, don't walk, run, run to go get some help in getting yourself in compliance for this regulation.
Roger, when you mentioned pass-through entities, it occurred to me that it's important to be clear, though. It's one thing to say that some of the nastier aspects of the withholding tax regime will be disapplied in an IGA world, but the reporting won't be. So a lot of those entities you talk about, and particularly in investment fund context, there still will be lots of paper floating around. So the extent to which there are beneficial owners, 1, 2, 3 steps removed, the IGA laws will still require and enforce the paper trail to be escalated up through and ultimately to the IRS. In a sense, the reporting regime still exists in a pass-through context. What doesn't happen, though, is the penal withholding tax.
Right. Thank you for that. In the last few minutes we have, I want to make sure we don't lose one other constituency in this. Both of you, Richard and Mary, have alluded to the concept of a responsible officer, and that sounds very scary to me, given the penalties, given the compliance burden, given how difficult this is, the ambiguity in the definitions. Could we just pause on that and explain who that person is and what their obligations are? Whoever wants to take it.
I'm happy to. I mean, the concept itself is in the original FATCA regulations. Is that an officer of the business, or possibly an officer of a business that takes compliance responsibility for another entity? So there is a concept of you sponsoring entities and having that responsibility. The idea is taken from a number of precedents elsewhere of people signing in blood on the dotted line that their firm is in compliance. I think where concerns arise is that is a criminal liability. And the concept of materiality that you might have in, say, a traditional financial reporting context, if the CFO was making a parallel certification over financial statements, when you're talking about tax amounts, people are a lot more sensitive. It's a lot more right or wrong. In terms of who's doing it, we're seeing actually a range of people: compliance officers, tax officers, CFOs, chief operating officers. There's no requirement that it's a particular individual. It just needs to be someone who has the authority in order to sign off on behalf of the firm. The challenge for that individual is the personal risk he's taking over the certifications. And there's 3 or 4 certifications that he'll have to do. There's initial certifications over the due diligence and the housekeeping you're going to do over the next few years, over your existing customer base and your systems and controls. And then there'll be an annual or a more regular certification on an ongoing basis. And actually, to be honest, the biggest challenge is finding someone who's prepared to do this. I mean, this isn't something you put your hand up for. This is something you get told to do. But I'll go back to my earlier point. In most jurisdictions with an IGA in place, the responsible officer concept is off the table. You're subject to the local law of that jurisdiction. And therefore, it's an issue for big multinationals that have touch points in compliance and IGA and non-IGA countries. It's a practical reality there. But for most of the community in this part of the world, and the VC and PE community, you're more likely than not going to be dealing with recognised IGA jurisdictions. So I wouldn't want to overemphasise responsible officers as the headache that it could be for others.
Okay. Mary, any concluding comments?
Well, I was just going to add on responsible officer from like a reality perspective. It's kind of like a hot potato that everybody's throwing around, trying not to be it, and it's not totally clear if it's going to be, like the CFO of the entity or if it's the head of tax or how it works. But it's fun to be involved in all of the politics associated with facing regulation. Parting words on it is it's here to stay. I think we were absolutely right that this is something that is really happening. There's been talk in the past of maybe a regulatory solution, or I think it's Rand Paul is out trying to get it removed, but I really think that there has been so much motion forward in this regard that even if the U.S. version modifies or changes, there's been so many international treaties negotiated at this point that I think it's here to stay, and it's time to get on the train because it's going to leave the station.
Okay, thank you, Mary. I'd like to thank both our panelists, well, all of our panelists. It's been a very informative webinar. I don't know if I recall learning so much myself at a webinar as I have today. There certainly is a lot here and a lot to learn and a lot to come. I'd like to remind the folks that you will find the materials on SlideShare as well as Royse University, the Royse Law YouTube site, and in the iTunes store as a podcast download. And please stay tuned. We will have future webinars coming up on technology topics, food tech, as well as health tech and the burgeoning field of transportation tech. And with that, I am going to conclude the webinar.